Okay, here we are in week 4 already of Finance 1031. We'll look today at some more ratios, a good chunk of review, and something called common size statements. Okay, so far we've got current ratio, quick ratio, both a measure of how fast a company can pay its immediate bills. Gross margin percentage, which is a fairly big ratio when it comes to looking at gross profit. And then net margin, all the leftovers, percentage, okay, the net profit. Looked at debt to equity, a little bit why it's important that bankers want to lower their risk or lenders want to lower their risk, so they want to see that you've got twice as much money invested as they do, so the debt to equity should be 1 to 2 at least. 1 to 3 they like a lot better. Return on earnings, return on assets, which is just a version of return on investment, depending on where you sit. If you're an investor in the company, your return on investment would be your return on equity. And if you're the company investing in something, your return on investment is going to be your return on assets. Okay, and the broad definition return on asset is the income returned to the investor divided by the amount invested. Okay. And sometimes if we're thinking about things a little more complex, instead of just dividends that we might get back, we also look at the increase in the value of the investment. And this is something that, of course, people look at on the stock exchange. They want to see that their shares going up and the value of the shares is going up and that they're getting some dividends or some income, direct income. Okay. So again, quick review, return on equity is just the net profit divided by total equity. This is a return on the overall investment by the shareholders. And of course, return on assets equals net profit divided by total assets, which is the return on overall investments made by the company in assets. So return on investments in both cases, but one is equity and the shareholders, the other is assets and the company. Okay, quickie note on net profit. Basically, when we talk about the company at the end of the year, we're hoping it makes a profit, so let's just assume it does. It's money left over at the end of the year after your suppliers are paid, after the overhead is paid, so the rent and all that sort of thing. Suppliers might be, if you're selling chairs, might be plastic and steel and that sort of thing, or if you're selling candy bars, might be Hershey's for all we know. Okay, and once we've paid some financing, and that would be interest costs, of course. And once we pay the government, which is income tax, we only pay the government taxes, of course, income tax, if we have a profit. So, good and the bad side to that, we don't have to pay them if we have a loss, but who wants a loss? If we have a profit, they want a piece of it. That's basically the way it is. So everybody's paid, and then if you're going to put the shareholders on the income statement, you can pay them dividends. Okay. You could pay them all the net profit because, in a sense, they're kind of entitled to it. But usually, companies hold on to a good chunk of it so they can invest it and have a cushion, a cash cushion, in case of bad times or whatever the case may be. So, net profit is what's left over after everybody's paid. Now, as a shareholder, if I only own part of the company, i.e., not the whole company, I got a few partners, I'm only entitled to part of the net profits. So if I invest $1,000 in a company, I get 400 shares out of the 1,000 shares. I'm entitled to 40% of net profits. Okay, I own 40% of the company. Okay, so if the earning after taxes is $100, that's their net profit, by the way, also known as net profit, then theoretically $40 is mine, and my return on my investment would be 40 over 1,000. Remember, I put $1,000 in, and that will be 4%. So that's not too good. Out of an investment like that, you'd want $100, $120, 10, 12%, something like that. So that's something to think about. If you're a partial shareholder, you only get or are only entitled to a part of the profit. Okay, so that's where even though a company's entire net profit might be 10%, which looks good on paper, the shareholders, if they don't own all of the company, their return on investment gets a lot correspondingly lower. Okay, we're on to one of our new ratios. As the title suggests, this is a ratio that bankers are interested in. It's called interest coverage. And basically, it has a look at your profit compared to your interest expense. So if we take earnings before interest and taxes and divide that by interest, we're going to get a number. And hopefully that's 5, 6, 7 times at least, something like that. And it basically what it says is that's the number of times you could have that interest expense paid for from your EBIT. So if your EBIT's 10 times your interest, if your EBIT's $1,000 and interest is $100, then you could afford to pay that interest expense over 10 times. Okay, so that's what the number's getting at. 3 times is good. Okay, 4 times is really better, a lot better. But still, at 4 times, that means that 25% of your profits, earnings before interest and taxes, 25% of it is going to the bank. Okay, I prefer personally about 7 times or higher. That means a lot less money is going to the bank, and you get to keep a lot more in the company. And that's a good place to be. Banks usually look at 1.5 times as a danger sign. Personally, I prefer a lot bigger than that. I don't like giving my money to banks; they're a necessary evil. They'll help you boost your return, your own return. But at the same time, sometimes when you start up, that's what you need to do. Or if you have a bad year, that's what you're looking at. So 1.5 times is really not a very good place to be at all because you haven't got much cushion for room or for error if your revenue drops a bit. Okay, so to the banker, it's an indication of how well the company can pay or cover its interest payments from its profits. Okay, so once the cost of sales is paid and once the rent and all that other stuff is paid, then the banker's looking at, okay, can they pay me interest after they paid all the rent and everything? Okay, they want to see that you can afford it. They want to reduce their risk. Okay, use with the debt to equity ratio to decide whether or not you should be eligible for a loan. Some bankers use EBITDA, so they take amortization in because it's a non-cash expense. They add it back in. Um, since it's interest they're interested in, and the interest is a cash expense, and that's the sort of thing they might look at. But EBIT is a conservative number, i.e., it's going to give you a lower number. And so we tend to, when we're having a conversation about this ratio, tend to talk about EBIT, although some banks will use EBITDA. Just depends on the bank. Okay, so just further words on that ratio. Ability to cover your interest payments, and there's a key word, principal payments. I didn't explicitly mention that last slide. So if I'm paying a mortgage, usually it's a blended payment. Part of it's interest and part of it's the principal, which would be the current portion of long-term debt, and leases on your equipment and or sometimes rent, depending on what the company does and most of the time will include rent in there. Okay. Shows that the company can pay back interest on the loans, pay back the loans themselves, and still pay equipment, premises, leases, and survive. Okay. This ratio is used by bankers with the debt to equity and the interest coverage ratio. Now, the interest coverage ratio gives a picture of the company's ability to pay the interest on the debt. Okay, the banker would be concerned about the debt. The fixed payments talks about the debt, or excuse me, the interest and the principal repayments. Okay, so we've looked at bankers' ratios. Notes about the exam coming up in week 7. It'll be in everything up to and including the end of week 6. The format is usually mixed between you have to do some Excel things or be able to handle Excel and do some financial statements, retained earnings, amortization, that sort of thing. Multiple choice on some of the definitions, and then multiple choice on some of the numbers calculation using Excel. Typically, it's about an hour long, around 50 questions, and again, covers everything up to the end of week 6. It's totally online.